And welcome to the Aaron Katzman Show. I'm your host, Aaron Katzman. We speak to your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon-to-be financial capital of the world, Jerusalem, Israel. If you like this content, please subscribe to both our YouTube channel and to the podcast if you've not yet done so. So, guess who wrote this 2 years ago? It's been a roller coaster, but all in all, 2021 has been a good year in financial markets. The markets have withstood multiple COVID variants, lockdowns, surging inflation, and anticipation of higher interest rates. As I have mentioned in previous columns, while the major market indices are not far off from their all-time highs, many popular and widely held stocks have tumbled 20% or more. In fact, almost 30% of all gains in the S&P 500 this year come from just 5 companies. That means that the other 495 have not really pulled their weight. Remember Zoom? They have taken over the world and eliminated the need for face-to-face meetings. Well, their stock is down nearly 60% in the last 10 months. That was a flashback. Who wrote that? I wrote that. That's me. I'm a genius. Why am I such a genius? Because when I was reading that, doesn't that sound strikingly familiar to 2023, right? Without COVID, but soaring inflation, instead of potential higher interest rates, surging interest rates, right? Everything is like war. There are wars in the world. And this year, it's like the Fantastic Eight, right? They're like 8 stocks which have carried the indices on their back, right? And brought the market with them. Although the majority of stocks have not really done much for most of the year, the last couple of weeks notwithstanding, right? Funny how history repeats itself so soon after it happened. Just like 2 years ago, it was the exact same story as this year, which sort of got me to thinking. It got me to thinking a couple of things, and maybe it's some misconceptions that analysts have when they complain about the fact that, only, only 5 companies contributed most of the gains of the market. This year, 8 companies completed. Well, hello, if that's happened to the last 3 years, it's not this, and it's not all the same companies. Maybe there's something else going on here. There is evidence that owning individual stocks may not be the best way to secure your financial future. JP Morgan came out with a report titled The Agony and the Ecstasy, the Risks and Rewards of a Concentrated Stock Portfolio. It's a report based on 40 years of data. They started data taking in 1980 and show that owning an individual stock statistically probably wasn't such a great idea. In the report, Michael Sembalist writes, how often would a family have been better off or better or worse off owning cash or the Russell 3000 index instead of the concentrated position? Around 40% of the time, a concentrated position in a single stock experienced negative absolute returns, in which case it would have underperformed a simple position in cash. At around 2/3 of the time, a concentrated position in a single stock would have underperformed a diversified position in the Russell 3000 index. While the most successful companies generated massive wealth over the long run, only around 10% of all stocks since 1980 met the definition of mega winners. If you were lucky enough to own one or more of the mega winning 10%, then those positions had huge returns. He continues, more than 40% of all companies that were ever in the Russell 3000 index experienced a catastrophic stock price loss, which we defined as 70% decline in price from peak levels, which is not recovered. That is fascinating research. It also goes against conventional wisdom, which says, well, only a few stocks are propping up the market. So what? So either markets are going to drop because at some point those stocks are going to drop, or at some point things are going to broaden out. Well, historically, that doesn't really happen, right? Only 10% of the stocks in the last 40 plus years were mega winners. Most stocks, like most, didn't perform well at all. That's not anything to write home about, right? 40% underperform cash. I mean, that's horrific. So the problem with owning so many stocks is for investors, they don't have the time to really analyze and follow, right? In order to really do this right, you probably need 30 to 40 different positions in order to have enough mega winners to pull your whole portfolio to seriously higher levels, right? For most people, it's impossible. It's not efficient to do so, right? Either they should use a money manager who can do that, although statistically, buy 30, 40 stocks on their own, which is time consuming and hard to follow, or use like index funds or ETFs. Right now, everybody's talking. There's been a lot of, I've watched on Bloomberg and stuff, everybody's saying, well, the problem with ETFs, the whole world is indexing. Everybody's buying ETFs. And as such, you can't even find, it's virtually impossible to find those mega winner stocks, because even if you find them, because all the money's in indexes, and these are like small companies which don't make up much of the index, they're not going to move up. And that's taken as conventional wisdom. And I was thinking, well, that doesn't make any sense. Right? If you look at the breakdown, right, of the indices, they change over time, right? There's like a yo-yo. The same stocks which were made up the majority of the S&P 500, the NASDAQ, whatever index you want, has changed dramatically, especially in their weightings over the last 10 years. The last 40 years, for half the companies weren't even around, and the ones that were the leaders there back 40 years ago don't even exist today, right? So there's something when you own ETFs or index funds, there is a certain dynamism. There is a dynamic nature to that index, right? Successful companies grow, they get bigger, they become higher weighting in the index, and the has-beens, right, the Intels of the world, the Ciscos of the world, I'm not ragging on them, but like yesterday's favorites, you'll find them on your favorite 80s oldies station, right? They're not to be found they don't have much of an impact anymore on the index. So I think I take issue with this movement now saying it's for private equity. You got to buy. The only way that you can find the diamond in the rough is through private equity. I don't think that's true, right? Indexing is not the most terrible thing to happen. I understand some of the downsides with indexing, but at the end of the day, indexes are dynamic. They change over time. And if they change over the time, that sort of means that you're getting the latest and the greatest, right? It's not such a bad idea, ultimately. And as we've seen statistically, it's really hard to find a diamond in the rough. It's virtually impossible to find a diamond. So for most people, most being defined as like 99%, indexing ETFs is probably the way to go. People ask me all the time, well, what stock should I buy? And I'm like, the total market index. You shouldn't buy some random individual stock. It's very binary ultimately, right? It's either going to go up or going to go down. Chances are it's not going to do better than the market unless you sort of get lucky, right? Unless you can beat the statistics, which doesn't happen very often, right? The top minds on Wall Street tend to not beat their own benchmark. So how are you going to do it, right? You don't have any more information than the top guys in Goldman Sachs, right? You don't have any more information than they have. You get the information a little bit later than they have, and so they can trade on it quicker than you, right? So don't think that you've got, the Kool-Aid. You don't have the secret sauce to incredible investment returns, because statistically, it just doesn't happen, okay? And you don't want to end up being one of the statistics, right? In the search of a mega winner. You want to be one of the people who invested intelligently, strategically in an index and just grew their money and kept adding money and grew their money over time. Because that's really the time and true way of growing your portfolio and growing your wealth over time. Thanks so much for tuning in. You've been watching the Aaron Katzman Show, where we speak about your life, your money, and your investments. If you've not yet done so, please, please, please subscribe to both the YouTube channel and to our podcast. Thanks so much for tuning in, and we'll speak to you soon.